A company once deemed on the brink of disruption staged a remarkable turnaround after its stock plummeted 70%. Over 2 years, its stock surged sevenfold. This is another highly controversial company whose management evolved from being widely criticized for neglecting core business to becoming one of America's most effective teams. Riding the AI wave, the company pivoted swiftly to seize the industry's high ground. Today, this transformed entity appears to offer investors entirely new opportunities. This is Meta, one of America's major tech giants. Today, we'll conduct an in-depth analysis of Meta. How does Meta generate revenue? Most readers likely know it's fundamentally an advertising company, with 96% revenue comes from advertising. Using traditional analysis methods, we'd need to dive deep into every business line to see how advertising performs within each. However, this approach is incredibly difficult and often leaves us lost in a sea of data. So today, I'll share an analysis method I personally favor, what I call the top-down approach. It can be applied to any company primarily driven by advertising revenue. Method involves first decomposing the company's total advertising revenue by time, then conducting in-depth analysis of each factor. This process is slightly complex. A company's total advertising revenue equals its total ad impressions multiplied by its average cost per click, CPC. This concept should be straightforward. The chart below shows Meta's growth rates for total ad impressions and CPC over the past 3 years. Note that it displays growth rates, not absolute values. The light blue line represents the growth rate of ad impressions, while the dark blue line shows the growth rate of CPC. Since 2023, when Meta began recovering from its low point, the growth rate of ad impressions has been gradually declining, while the growth rate of CPM has been steadily increasing. What exactly does this mean? We'll discuss that shortly. For now, looking at this chart alone, we still can't draw any meaningful conclusions, so we need to break it down further. In this formula, total ad impressions can be further decomposed into monthly active users, MAU, data and impressions per user. Simply put, this equals the total number of users multiplied by the number of this should equal the total ad impressions, which is straightforward. We can break down this formula further. The impressions per user can be decomposed into the user's session duration multiplied by the ad density per unit time. Why this breakdown? Because for all content companies, the core metric isn't user count or revenue, it's session duration. For content platforms, session duration means everything. Longer sessions indicate compelling content, naturally attracting more users. Longer usage time also means more advertising opportunities, which naturally leads to higher revenue. Therefore, whether it's social media, search engines, or even humble content creators like us, their core objective is to keep you engaged for longer periods. Alright, at this point, the formula has been fully broken down. Let's write it out completely. Total advertising revenue equals monthly active users multiplied by single user usage time, multiplied by advertising density per unit, time multiplied by unit price. Next, we can analyze each factor individually. Any growth in these factors will drive overall revenue performance. As investors, we need to understand which factors are critical to a company's growth and how they will evolve in the future. Among these factors, the least important is advertising density per unit time. This refers to how many ads you can place while users are using the product. You can't recklessly cram more ads into the product just for growth. Even if it drives growth, it's unsustainable because it inevitably harms the user experience. Of course, some companies do this. Companies that do exactly that. Meta's management has stated they are actively controlling ad density internally, having observed it beginning to negatively impact users. This makes perfect sense to me, and we shouldn't expect it to drive any growth either. Next, let's examine individual user engagement time. ZOX statistics on global social media usage time show that the time users spend on social media has essentially plateaued with no growth. Take last year, for example. Meta's short video app Reels aggressively pursued market share but ultimately only increased its user base by less than 1%. Looking ahead, the segment is also unlikely to deliver significant growth. What about monthly active users, MAUs? Meta's monthly active users over the past 2 years show consistent growth. A key reason Meta rapidly climbed from 5th place in recent years was the rapid user growth driven by new products like Reels and Threads. However, this incremental growth now appears largely exhausted. Recent quarters show MAU growth has reverted to an average 5% rate. With no comparable new product lines like Rios or Thread expected by 2025, MAU growth is projected to remain at 5%. Business analysis shows that the total ad impressions are determined by the product of three factors: ad density per unit time, average usage time per user, and monthly active users. We can see that Meta's total ad impression growth has gradually declined over the past 2 years, reaching only 6% in the most recent quarter. Given that MAUs account for 5% of this growth, the remaining two components, each around 1%, align with our earlier analysis. This segment's growth is expected to remain stable or potentially decline further. The most critical metric for Meta is its advertising price per unit. Over the past 2 years, the company sustained over 20% revenue growth primarily through rapid price increases. The company's future growth hinges on whether CPM can continue driving acceleration. Meta's short video platform, Reels, delivers superior ad performance. With the rise of Reels, more ads are being pushed on Meta's short-form video platform, and advertisers are willing to pay higher costs for better ad performance, thereby elevating the overall average revenue per user. An even more significant factor is AI, particularly the company's AI-powered advertising service called Advantage Plus. Advantage Plus is a service that uses AI to automatically generate ads and distribute them. For advertisers, adopting Advantage Plus reduces both the complexity and cost of ad creation while improving delivery effectiveness. According to Meta's own disclosure, 4 million advertisers now use tools from Advantage Plus to create ads, a significant increase from just 1 million 6 months ago, demonstrating the product's growing popularity among advertisers. So, what will the landscape look like in 2025? Unlike in 2024, when both Rios and Advantage Plus were in their early stages, fueling strong growth momentum and certainty. Standing at this point in time, both platforms undoubtedly retain further growth potential. However, replicating last year's double-digit growth will be challenging. Based on management guidance, they anticipate the company's first quarter revenue growth will decelerate from 21% to 14%. As analyzed earlier, monthly active users, MAUs, can still contribute around 5% growth, with other factors remaining largely unchanged. This implies average revenue per user, ARPU growth will remain around 9%, reflecting management's cautious outlook on sustained high ARPU expansion. Overall, for 2025 revenue growth, we cannot expect any changes in ad impressions. The true key lies in boosting the company's average revenue per user, ARPU. This improvement primarily depends on two factors: further monetization of the company's Rios short video platform and the continued advancement of its AI models. Both areas still hold significant potential, particularly the AI models, which may continue to deliver surprises in 2025. However, it must be acknowledged that compared to last year, a slowdown in Meta's overall growth is now an inevitable trend. Beyond the deceleration in revenue growth, Meta also faces the challenge of rising costs. This stems from the company's massive capital expenditures over the past 2 years. After 2 years of accumulation, these capital expenditures are finally reflected in amortization. Management projects that total expenses for 2025 will reach approximately $116.5 billion. This equates to a direct 23% increase on the cost side, while revenue growth is projected to be only around 15% and is likely to decelerate further. This implies that the company's profit margins will be squeezed even more. Does this mean the company's growth momentum will come to an end? If you only look at the financial data, it's easy to draw that conclusion. However, the company's stock price still has two important growth drivers that will play a more significant role in the long term. The first is Meta's open-source AI model, Llama. Over the past year, the number of people participating in Llama's development has surged by 70 times over the past year, making it the most important open-source AI platform. Only as the number of users grows can the model's performance continuously improve, attracting more developers to contribute. This year, the company will launch its Llama 4 model, focusing on multimodal capabilities and AI agents. Both features can deliver impact in the short term. It must be acknowledged that the Llama model won't substantially boost the company's performance in the near term, and the company has no plans to monetize it. The success of open-source models hinges on network effects. And whoever establishes network effects first is most likely to build a robust moat. This mirrors how Google's Android system dominated the mobile internet era. For Meta, Llama's greatest value lies not in monetization, but in its ability to enhance the capabilities of the company's other products. The previously mentioned Advantage Plus is one such example. Meta's second growth engine, and the most critical application scenario for Llama, is Meta AI. What exactly is Meta AI? According to the company's own description, Meta AI is a highly intelligent personal AI assistant. Since its launch 6 months ago, Meta AI has been deeply integrated into Meta's social platforms. Users can now access it through the search bar to engage in direct conversations. In fact, Meta AI holds immense significance for the company's long-term investment value. It has the potential to pioneer entirely new application scenarios. Leveraging data from its 3 billion users' deepest social and lifestyle activities and built upon the Llama Model Foundation, Meta is theoretically one of the most capable companies to develop consumer-facing AI applications. More importantly, compared to products like OpenAI's ChatGPT, Google's Gemini, and Apple's Siri, all positioned as personal assistants, Meta AI boasts the industry's strongest business model in the industry. Have you noticed that ChatGPT is now also trying to understand you? Even so, the data it possesses pales in comparison to the vast user data Meta has accumulated over years. Moreover, Meta's ad-driven revenue model perfectly benefits from this scenario. With Meta AI's capabilities, Meta can better understand user preferences to deliver more precise ad targeting across its existing platforms. Crucially, it can even serve ads directly within Meta AI itself, leveraging all social data and your personal preferences to recommend products with pinpoint accuracy. Whether through traditional ad delivery or these novel advertising scenarios, ad effectiveness will see a massive leap forward. With such precision in ad delivery, why would advertisers hesitate to increase their bid prices? This will undoubtedly further boost the company's performance growth. So, why is Meta considered the most advantageous among all companies? As mentioned earlier, ChatGPT's data collection capabilities fall short compared to Apple's strengths in offline usage data. However, Apple struggles in the online space and lacks sufficient expertise in advertising monetization. It will take time for Apple to master this area. Online, its strongest competitor, Google, possesses solid user data. However, if Google aggressively expands Gemini's application scenarios, it risks undermining its core search business, a self-cannibalizing dilemma. Meta avoids this trap by fostering mutually reinforcing growth. Thus, Meta's business model theoretically provides the most fertile ground for Meta AI as a personal assistant. Of course, whether these strategies bear fruit within 2 to 5 years remains highly uncertain. Currently, management isn't expecting rapid realization of this vision. For investors, we must maintain reasonable expectations and view Meta AI's value through a long-term investment lens. So, how should we assess this Meta investment? First, the company's outstanding performance over the past 2 years has primarily been driven by earnings. The company's short-term earnings have now peaked, a trend that is both inevitable and highly certain. This signals the end of an era where profits could be reliably generated through fundamental analysis alone, and future investments will become significantly more challenging. By 2025, Meta's visions, whether the open-source Llama platform or Meta AI, are unlikely to bring substantial transformation to the company. They remain largely in a foundational, strategic deployment phase. Of course, the possibility of an accelerated technological breakthrough cannot be ruled out, but this is beyond the scope of investor expectations. Therefore, for Meta in 2025, within the future AI era, Meta is theoretically the most advantageous company in terms of technology, data, and management execution. I even believe it is the most investor-friendly company among all current AI application layer tech giants. Most other AI application layer companies, even if they possess AI capabilities, don't know how to monetize them. Examples include Apple, Amazon, and Netflix. Either lack performance backing like Tesla, or engage in internal conflicts like Google. Meta, however, possesses sustained performance support, with its existing business and AI capable of mutually reinforcing, spiraling upward growth. This is a company with a solid floor, extremely high ceiling, and a clearly visible development path. Whether it ultimately achieves these visions remains unknown. But at this stage, what we investors can do is invest in companies with the greatest potential. And Meta is precisely the kind of enterprise I believe in. That's why I say Meta is a company that can easily generate profits for us investors. And with that, we've covered the entire analysis of Meta.